NIIT Technologies has started the new fiscal on a strong note with encouraging Q1 numbers, including strong revenue momentum, strong deal wins, as well as management's confident commentary on robust growth in the quarters ahead. Let's do a three-point analysis of the earnings fine print and the outlook on the company. 1. What are the key positives in Q1 results? Well, Q1 revenue in Indian rupee grew 3% sequentially and 4% in constant currency terms. The constant currency growth also factors in divestment of the India GIS business and acquisition of Wishworks IT Consulting. There's a 15 days revenue impact of about 10 crores. Now, in terms of verticals, insurance and travel and tourism have also shown healthy growth in Q1. Albeit the margin dip in the quarter, the company is confident of maintaining an 18% operating margins. Order inflow momentum also remains strong, with the company bagging in orders worth $175 million in Q1. Now, the unexecuted order book at the end of Q1 also stood at $395 million. The share of digital revenue stood at 34% at the end of Q1, with a year-on-year growth of 46% and sequential growth of 12%. Now, there is no overt macro concern impacting the business. Also, management says that the UK business has not been impacted by Brexit, adding that the ownership change has also not impacted the employee morale or the attrition, which remains stable at range bound at a rate of 12.9% at the moment. 2. What are the key concerns? Now, there was a decline in the key BFSI client whose IT spend has declined. Now, this has impacted revenue across the top client buckets. The management, however, has clarified that it has not lost wallet share and also hopes to recoup the business should the client's business comes back. Now, operating margins also slipped in Q1 due to the wage hike and visa costs. 3. What's the outlook on the company? Well, NIIT Tech has a strategic clarity in terms of its focus on verticals and geography. The business outlook remains quite strong under the new private equity promoter Bearing, which is likely to drive growth from here. The management also has seen no adverse reaction from clients or employees due to the ownership change at the moment. Now, the open offer had limited the downside for the stock in a rather turbulent market in the recent times, and the stock has been an outperformer in the market in the sector. Well, clearly the best in class in the mid-cap IT space, the valuation at 15 times FY21 expected earnings leaves little room for error right now. Also, investors should look at adding the stock on any declines that they find.